Welcome to Skytech-Lens. We're at a turning point in global finance, a moment that could reshape the world order for decades. In early 2025, the Trump administration issued a blunt ultimatum. Global banks must stop enabling Iran's oil trade with China or lose access to the US dollar. This wasn't just another sanction, it forced a choice between the world's dominant currency and its second-largest economy. The goal: cripple Iran's shadow banking network, but at the risk of the dollar's supremacy. It's a high-stakes gamble, betting the world can't live without the dollar, even if it means a direct clash with China. Tonight we break down the players, the stakes, and the future of global finance. In early 2025, the US Treasury's ultimatum hit global banks like a shockwave. The message cut all ties with entities, especially in Hong Kong, processing payments for Iranian oil to China, or be cut off from the US dollar system. For banks, losing dollar access is existential, like being banned from every airport in the world. Over 80% of global trade is settled in dollars. Exclusion means losing multinational clients and access to the world's deepest capital markets. The response was immediate. Boardrooms from London to Singapore called emergency meetings. Compliance officers, long ignored, suddenly had the CEO's full attention. The choice: abandon lucrative China-Iran business and risk angering Beijing, or defy the US and face financial ruin. Most banks chose compliance. Major European and Japanese banks began cutting risky Hong Kong clients. The Hang Seng Index plunged as investors feared a Western exodus and Hong Kong's status as a global hub came under threat. But as Western banks retreated, others saw opportunity. Banks with little US exposure, especially those close to Beijing and Moscow, moved in to fill the void. A parallel financial ecosystem began to take shape, designed to operate outside US reach. The ultimatum drew a line: on one side, banks tethered to the dollar and US policy; on the other, a coalition building alternatives. The US had weaponized the dollar more aggressively than ever, but in doing so, it gave rivals a reason to accelerate their escape plans. The Hong Kong Monetary Authority condemned the move, but markets remained rattled. The global financial system, once integrated, was now fracturing along geopolitical lines. The US had shown its power, but also the risks of overdependence on a single currency. The ultimatum didn't just shake banks, it awakened a global push for alternatives, setting the stage for a bigger confrontation. To understand the US crackdown, we have to look at Iran's shadow economy, a network built to survive sanctions and fund its military. Iran's system is a web of front companies, clandestine shipments, and financial trickery. Oil tankers go dark, swap cargoes at sea, and rebrand Iranian oil as Malaysian or Iraqi. But the real magic is in the money trail: payments routed through shell companies in the Marshall Islands, then funneled through Hong Kong and the UAE. These companies pose as legitimate traders: electronics, textiles, agriculture, masking huge currency flows for Iran. The US Treasury's OFAC plays cat and mouse, sanctioning one network only for another to pop up weeks later. This shadow banking system funds not just Iran's government, but its military proxies across the Middle East. Every barrel sold through this network, the US argues, translates into weapons for groups hostile to American interests. Iran's evasion tactics are sophisticated: hawala transfers, barter deals, even cryptocurrency mining. Each new sanction is a lesson, making the network more resilient. By 2025, US officials estimated over 1 million barrels a day were moving through this system, billions in revenue, undermining sanctions. Sanctioning shell companies wasn't enough. The US decided to target the banks themselves, betting that licensed institutions couldn't just disappear. The goal: sever the link between Iran's oil and China's refineries. But in a globalized world, money finds cracks. Iran's shadow network is a testament to that, and the reason the US raised the stakes. While Iran evaded sanctions, China was building something bigger: a financial system that could survive without the dollar. Beijing's goal was clear: reduce vulnerability to US financial power. The 2025 ultimatum turbocharged this effort. The centerpiece: internationalizing the yuan. China signed currency swap deals, letting partners trade directly in yuan. CIPS, China's answer to SWIFT, became the backbone for cross-border yuan payments, especially as banks shunned dollar transactions. Digital payments like Alipay and WeChat Pay, already dominant in China, spread along Belt and Road trade routes. The digital yuan, or ECNY, took it further: a state-controlled, programmable currency for cross-border payments, bypassing US systems entirely. When Western banks cut off Hong Kong clients, Chinese banks stepped in, using CIPS and Yuan to keep oil flowing from Iran. The Shanghai International Energy Exchange saw a surge in Yuan-denominated oil contracts. For sanctioned oil producers, the choice was simple: sell for Yuan or not at all. China's approach was patient and strategic, building alliances, wiring countries into its financial standards, and making de-dollarization a key agenda. The US crackdown convinced even neutral countries to seek alternatives. The financial divide was no longer just US versus China, it was global. The US ultimatum was meant to project strength, but its aftershocks hit home hard. Cutting Iranian oil from the market tightened global supply, spiking crude prices. American consumers felt it at the pump. Higher gas and diesel prices rippled through the economy. The administration responded with tariffs on Chinese goods, but those costs landed on US businesses and families, fueling inflation. Proposals for gas tax cuts and energy credits only added to the confusion. The national debt climbed as subsidies tried to offset rising costs. Foreign investors wary of US unpredictability began diversifying away from Treasury bonds, buying gold, euros, yen, even yuan. This de-dollarization put upward pressure on US interest rates, making borrowing more expensive for everyone. Higher rates slowed the economy, raising costs for mortgages, car loans, and business investment. American companies with global supply chains faced new risks: comply with US sanctions and risk Chinese retaliation, or vice versa. The policy, meant as a decisive blow abroad, became a double-edged sword at home, fueling inflation, uncertainty, and political backlash. The ultimatum exposed the dollar system's vulnerabilities. Instead of falling in line, countries began building alternatives. China and Russia accelerated de-dollarization, trading in yuan and rubles. Emerging economies like Brazil and India explored trading in their own currencies. Even Europe pushed to strengthen the euro's global role, frustrated by US unilateralism. China formalized its unreliable entity list, threatening foreign companies that complied with US sanctions. Multinationals were caught between conflicting legal regimes: comply with one, risk punishment from the other. The global financial system began to fragment, with competing blocks and standards. Overuse of sanctions made countries immune. They learned to operate outside the dollar, as Iran did, or found new partners, as China and Russia did. In the Middle East, even OPEC nations started discussing accepting other currencies for oil. The petrodollar system, a pillar since the 1970s, was under strain. The dollar still has huge advantages: deep markets, trust, inertia, but the risk calculation has changed. The world is no longer asking if it should diversify away from the dollar, but how fast. The US used its greatest weapon, but in doing so gave the world a reason to disarm it. So, what's the verdict on this high-stakes gamble? The ultimatum worked in the short term. Banks complied, flows were disrupted, and US power was clear. But the long-term consequences are more troubling. Weaponizing the dollar so aggressively exposed the world's vulnerability and galvanized rivals to build alternatives. China, Russia, and others accelerated their push for a non-dollar world. The result, a rapid shift toward a multipolar financial system. The US move, meant to preserve dominance, became the catalyst for its erosion. At home, inflation and higher borrowing costs became political headaches. The world is now more fragmented, with competing blocks, currencies, and rules. Multinational businesses face new risks, and the risk of miscalculation is high. The debate over money and power has fundamentally changed. The dollar's role as unchallenged hegemon faces its toughest test since the Cold War. The question isn't if the dollar will be challenged, but how quickly and how deeply. The administration bet on the world's need for the dollar, but power used too aggressively breeds resistance. The gamble may have won a battle, but it risks losing the long-term war for financial supremacy. The world is now building a future where it can't be held hostage by one currency. The story isn't over. The consequences will play out for years. The dollar's gamble has set a new, more confrontational course for the global economy. The stability we once took for granted is now in question. The world is watching and waiting to see what comes next. We've traced the fallout of a single, powerful decision, an ultimatum that redrew the map of global finance. Cutting off Iran's funds may have worked, but it spooked the world, accelerating the move toward a fractured multipolar system. The US traded long-term trust for short-term wins, and the aftershocks are being felt everywhere, from foreign capitals to American wallets. The world is at a financial crossroads, and the path chosen now will define the century. What do you think? Did the US overplay its hand? Can the yuan or another currency really challenge the dollar? How will this power shift affect global trade and energy? Let us know your thoughts in the comments. We love to hear from you. Thanks for watching a video. And subscribe to the channel now. Thanks.